All right, so guys, what we're going to start out with is we're just going to tell you a little bit about ourselves. I'm going to let Shane go first.
That's awfully kind. Ladies first. Thanks, Dad. So yeah, if you haven't gathered by me just saying dad and father, and I don't know if I called him father yet, but he is my father. He got me started in the industry when I was about 15, cold calling against my will, basically had me chained to a desk, making 9 hours a day making calls. But I've been back in the fold now with him for about 8 years as a loan officer. I'd like to consider myself a first-time homebuyer specialist, and I'm a millennial, and there are more and more millennials that are coming into the housing market trying to get a piece of that American dream. And I resonate with them. I feel like just across the board, there's a lot of misinformation. The World Wide Web is very wide. There's a lot of conflicting info. And after the collapse in 2008, it scarred pretty much everybody, including me by proxy, seeing my friends and family go through it. It's good to have someone who has good information, who can actually guide you based on what your specific situation is. So again, first-time homebuyer specialist. I'm also a down payment assistance specialist. We've helped probably 2 to 3 dozen people use down payment assistance to get into homes that they otherwise wouldn't have been able to get into. I'm going to touch a little bit on that a little later. And I'm a mortgage planning consultant. Mortgage planning is a little bit different from being a loan officer. Any loan officer can call themselves a mortgage planner, but most of the time they just pre-approve you, send you your pre-approval, and let you go on your way. The planning side of it is really going in depth and understanding what your needs are, what your wants are, and what your long-term goals are. So that's my, I'll pass it back to Barry.
Awesome. So guys, I've been a loan officer for about 21 years. I got started right after I got out of the precious metal and rare coin investment arena. I couldn't stand selling investments, so I decided to, I got recruited actually into the loan business. And I used to manage Novastar Mortgage back in the day. When Shane said he was chained to his desk, he's lying to you. I offered him money. That's what got him to work when he was 15 years old. Made $5,000 his first summer during when he was 15 years old, and took to it like a duck to water. I'm a United States Marine Corps veteran. I'm also a California Bureau of Real Estate certified instructor. I teach a course called MVHC, which stands for Military Veterans Housing Certification. So I got that because I served as the vice president for the Veterans Association of Real Estate Professionals in Orange County for about 3.5 years. It's a 501c3 nonprofit dedicated to educating veterans about their benefits and educating realtors how to best serve the veteran community. I'm also a reverse mortgage specialist. I don't know how much you guys know about the reverse mortgage, but it is a freaking awesome program. A lot of people look at it like it is a mortgage of last resort for people that are broke. But I have a case why I don't care if you make $10 million or if you have a $10 million portfolio, why you should have a reverse mortgage. And for you realtors out there, what you should be listening for is people that want to downsize. You know, they want to downsize, but they don't want a mortgage. Well, instead of paying cash for a place, they can take 50% of that and they can go and buy a property using a reverse mortgage and never have a mortgage payment for the rest of their life. That'll be in a different webinar that we'll be talking about. But today, what we're going to start off with is we're going to go over basically 5 different things. I'm going to real quickly go over the 2023 housing market forecast, and a high level view. We're also going to talk about a no income, no employment verification loan, which is called the Community Mortgage Program. It is freaking awesome, guys. We've used it several times over the last couple months. Might even scare you a little bit because it's so easy and such a great loan. We're also going to talk about the 2-1 buy down. Most of you guys have heard about this loan before. About the way that it's structured, but some of you don't. Maybe you've heard about it, but you haven't actually done it. I'm going to go into a little more detail. Shane is then going to talk about the DSCR loan, which is specifically for investors. It allows people to buy property without any kind of a qualification for income or employment as well. And Shane's going to talk about the down payment assistant and grant program. So the first thing I want to ask you guys, if you don't mind, in the Q&A area there, just kind of tell us, now that you've seen what we're going to talk about, I want you to type in there what you would like to get out of this webinar today. So at the end of this, we know whether or not we lived up to your expectations. Now, our objective with this webinar and with all of our partners is to add value and hopefully move the needle for you guys. So just feel free to jump in there, put in what you hope to get out of this, and then we'll address that a little later. So as far as the housing market forecast, I did a detailed video on this. We expect lower inflation. We saw from November until January, inflation was coming down in a big way, and so were rates. But last month, we got numbers from the PCE and the CPI, which is the Consumer Price Index, that was saying to the Federal Reserve that, hey, wait a minute, maybe inflation isn't coming down as quickly as we thought. And that's when we saw rates pop up a little bit. But we believe that's because that information is lagging information, and it comes back from, around the holidays. Everybody was, I don't know if you went to the mall, but it was a freaking madhouse at the mall. People were spending more money than they could probably afford because they felt like inflation was temporary. So we see that continuing. On March the 14th, the new CPI numbers are going to come out, and we see lower inflation ahead of us. We think we're going to probably see rates come down below 5% somewhere towards the end of the second quarter, maybe the beginning of the third quarter. We see a recession-like slowdown. Arguably, we might have seen a recession last year. Technically, we had two quarters that were had negative GDP, which it normally means a recession, right? But the government kind of rewrote the rules, but we do see that coming. But that's not a bad thing for realtors. If you look at the last 6 recessions, there's only one of them where the values of homes actually came down. The reason why is that the Federal Reserve actually lowers rates to fight recession. And what happens is that values go up. As rates go down, we see more people buying. So don't let recession scare you. We think that incomes have been coming up over the last 3 years pretty considerably for the majority of people. A lot of people have been laid off recently from these high paying jobs like at Google and stuff like this. But I mean, if you're an office worker or you're a blue collar worker, chances are you're making more money today than you were in, let's say, 2019. And we think that's going to help home affordability. You guys know as well as I do, because you're in the market, that inventory is very tight. In Riverside, maybe not as much as it is in Orange County and in Los Angeles County, but we still see this as being a very tight environment, and we do not expect to see a huge reduction in home prices. Maybe homes are on the market a little longer. Sellers are willing to negotiate a little bit more, but we don't see any kind of crash coming. Rents are still expensive and rising. And as rents are going up, it's kind of nudging everybody that doesn't own a home. Hey, I better buy something so I can lock in a monthly payment for myself. We also see single digit appreciation for the rest of this year. When I say single digit, I'm talking below 10%. We saw 20% appreciation almost in 2020 and 21. Last year, even though it was all over the news that, values were plummeting, we actually saw 10% appreciation according to the Mortgage Bankers Association of America, at least here in Southern California. We see appreciation continuing. Now, I have this slide because there is a family that we've helped out over the number of years where, I'm not kidding, like 2 of the brothers, 2 of the sisters, the father and mother, and they're all self-employed. We've got the father and the mother on track where they're W-2ing themselves, but because it's their own corporation, they need a couple of years of history to be able to qualify for a conventional loan. Well, the father, we just recently helped with what's called the community mortgage, and I want to share with you guys what this is. This is a loan that does not require any income documentation. It also doesn't require any employment verification. Now, this might scare some of you because you're going, oh my God, this is what happened back in 2008. But it's a lot more complex than that, folks. Shane and I were both in the market before 2008, and you just needed to hold up a mirror to somebody's mouth to see if they were alive to be able to get a loan. They didn't need any down payment. They didn't need any, I mean, they were all these ninja loans, option arms. If you want to go back and look at the root of what happened in 2008, that's what it was about. What they do with the community mortgage is there are compensating factors that they go by instead of your debt to income ratio. And the reason why you would need income is to calculate your debt to income ratio. But with this loan, they're not worried about that. The credit is underwritten based on your loan to value, how much money you're putting down, your FICO score, and your liquidity. They want to see that you've got other money put aside. It's for primary residence and second homes. The asset seasoning is only 30 days. You guys know that whenever you have a client, right, and they go, I have some money that I put in my mattress that I need to deposit into the bank, you go, uh-oh, you better do that now because the lender's going to want to see 2 months worth of asset seasoning. That is not the case with this loan. So with this loan, it's 30 days. Loan amounts up to $3 million with this community mortgage. The loan to value is up to 80% on purchase and rate and term. In other words, only 20% down required for a purchase, or if you're looking to get a lower interest rate. Now, the likelihood you're going to get a lower interest rate in this high rate environment is probably unlikely. But the family I just told you about, the father, it was a couple of years ago when rates were down around 3. He had a 7% bank statement loan that he was in, and I refinanced him down to 4%. Even though rates were 3%, we got him down to 4%. You think he was happy? He was ecstatic because he had 7 going down to 4. So most of the people that are in this high interest rate environment, all these investors know they're going to refinance at some point. You can also do a cash out up to 70%. So you need at least 30% equity to be able to do the cash out. Ideally, you're going to need more than 30%. Let's say you got 50% equity in your house. You could take out 20% to get you to that 70% level. The FICO score begins at 640. But honestly, folks, you should be listening for people that, have good credit. They have at least 20% down, and they have reserves. You're going to need to show that you've got at least 1 year's worth of reserves for that home in the bank. And if you own multiple properties, they're going to want to see that you've got 1 year's worth of reserves for all the other properties. So if you've got money socked away in a 401k in the stock market, but you don't show a lot of income, and you know what? This loan isn't just reserved either for self-employed people. I have another client we're doing one for right now who's only been on the job for about 11 months and is commission-based. So this client, we need 2 years worth of commissions to be able to qualify somebody for a conventional loan. So this is a perfect loan for this client because a year from now or 11 or 12, 13 months from now, we're going to be able to refi into a conventional loan because the client will have 2 years worth of reserves. So for us, it's as easy as 1, 2, 3, right? First, we're going to confirm their loan to value, make sure they have, if it's a purchase, at least 20% down. If they have 25%, even better. 30%, even better. They get a little bit of an edge on their interest rate, the more money that they have to put down. We're going to confirm that they've got a sufficient FICO. Again, the higher, the better. And then also we want to make sure that they have those reserves. That is key. All right. So, by the way, so what you should be listening for as a realtor when you're thinking about this loan is listen for people that are saying, you know what, I make a lot of money, I just don't show a lot on my taxes. By the way, there's another client that we're doing. I'm calling up the listing agent right after we're done here, who he is a plumber, been a plumber for a lot of years, but he doesn't have a corporation. And last year he didn't do so great last year. But he's got plenty of money in reserves and he's got plenty of money to put down. So we're like, look, let's do the community mortgage. A year from now, once you've got, that 1 year where you did really well behind you, then we can flip it maybe to a bank statement loan once rates go down and get you a lower rate. So you want to listen for that. So now we're going to talk about the 2-1 buy down. The 2-1 buy down allows qualified borrowers to reduce their monthly payments during the early years of the mortgage. The interest rate and the mortgage payment are reduced to 2% down the first year and 1% the second year. The buy down is paid from a seller credit. Then I'm going to show you in the next slide after this how that's calculated. There are a few different ways an agent can try to negotiate the seller's credit, which I'll show you here in a minute. This is usually more beneficial to the buyer, but it also can be more beneficial to the seller. The 2-1 buy down gives the buyer better home affordability for the next few years while they're waiting for rates to come down. They're still going to have to qualify based on the fully amortized rate, but it's going to give them that lower payment for the first couple of years. The idea is when rates come down, they'll refinance and do a permanent rate, or at least semi-permanent. It could be more beneficial to the seller if the buyer is trying to negotiate a drop in the sales price. It's cheaper for the seller to give a 2-1 buy down than it is more often than not in dropping down the sales price. And I'll show you how that works. The 2-1 buy down usually costs less to the seller. Shane lectured me about getting ahead of myself, so I apologize.
There's no lecture here.
No, he didn't lecture me, just advised me. The buyer needs to qualify for the fully amortized rate. So let's take a look at the 2-1 buy down calculator. So let's take a look at this. So in this particular case, this is a condo that I used for $620,000. This is the gentleman, by the way, I just told you about that we're working on a deal with right now. Interest rate at 6.25, 20% down. The fully amortized monthly payment, meaning without the 2-1 buy down, would be about $3,053.96. That's just principal and interest. That's not including property taxes, insurance, and whatnot. Okay. With the 2-1 buy down, instead of 6.25, the interest rate would be 4.25%. And the first year's monthly payment with the 2-1 buy down, based on this 4.24%, instead of $3,053.96, would be $2,440.02. Their monthly savings is $613.94 a month, which when you add all that up is about $7,367. Now, if we don't refinance them within the first year, it would go from 4.25 up to 5.25. Again, the fully amortized payment would be $3,053, but with the 2-1 buy down, instead of it being $2,440, it would pop up a little to $2,738, which would still be a savings of $315 a month, and a total savings over the year of $3,780.36. Now, when you add this up, this is how much it costs for the buy down. This is how much you're going to have to either ask the listing agent for, or as the listing agent, you're going to want to give to the buyer. Now, I always recommend to my agents that you try and get a little bit more than this, because it's also based on the interest rate. So while you're trying to negotiate a better deal for your client, or let's say it takes 3 or 4 days of back and forth, if interest rates pop up, you don't want to have to go back to the listing agent and ask for more money. So what I usually do is, on a situation like this, is I would tell the agent, go in there and ask for a $14,000 credit. And that $14,000 credit, whatever's left over, can go towards closing costs. So we just did one of these with a client that was a veteran, and it was $895,000 purchase or price. The listing agent was asking for $865,000. So our agent went in there and offered $895,000 with a $25,000 credit. The end result is that the seller wound up getting more than what they asked for, and we got our client this 2-1 buy down, which was a savings of almost $1,100 a month for this veteran for the first year. And it was like a little over $550 a month for the second year. And here's the kicker: 15-day escrow. We were able to close on a VA loan with a 2-1 buy down in less than 15 days. Guys, if you haven't been doing this for very long, I can tell you it's almost unheard of, because the VA gives the lender or gives the appraiser 10 days to get that appraisal back to the lender. We wound up getting the appraisal back in 2 days. So a 15-day escrow, and we got this client a 2-1 buy down. So what you should be listening for when you're talking to a buyer on a 2-1 buy down is things like, look, I could afford a bigger monthly payment. I just don't want it. I don't see myself paying $8,000 a month, for a $1.1 million home. It's just too rich for my blood. Well, if they believe that interest rates are going to go down, the 2-1 buy down is perfect for them, because let's just say that it was $1 million loan, and interest rates wound up going down to, let's say, 4.25%. Well, that 2% is a $20,000 a year savings, which, if you extrapolate, can be over $1,000. What is that? 20,000 divided by 12. It's $1,666 a month in savings if you do a 2-1 buy down on $1 million loan amount, if rates go down 0.5 point. So it makes a lot of sense for somebody to do a 2-1 buy down. Listen for those people that are talking about home affordability. And we don't expect you to be the expert on it, whether we're your lender or not. If you've got another lender, talk to your other lender about the 2-1 buy down. Make sure they're really adept at it. And then, usually we'll always talk to our agent. We'll ask them, is this something that you think that you're comfortable with? Because we don't want to talk about a 2-1 buy down if the agent, is for some reason doesn't think it's possible. Every once in a while, you run into a listing where, there's 10 offers on it. Well, 2-1 buy down may not work on that. So we always want to make sure that we're in communication with our realtor partners on that. So if you have any questions about this, go ahead and put them in the Q&A. We'll talk about it in a bit. With that said, over to my son, Shane.
All right. Yeah. To Barry's point, 2-1 buy down is not going to work. It's not for everybody, right? You have to not only convince the listing agent, but the buyer has to understand, the seller has to understand. We've actually talked with all 4 parties, really, trying to get them to wrap their head around what that is. But on that VA one that we got in there actually were 10 offers, 2 of which were 40,000 above our offer price, and we still won it. So it's a winning strategy for sure. Now, what I want to jump into now is the DSCR loan. So Dina mentioned she wanted to look at some different programs that are specifically for investors, non-QM stuff. This is one of them. So a little bit of a background: we had a realtor partner who owned a 6-unit condo, and she was going through a divorce, and basically she needed to buy out her ex, or soon to be ex rather. The issue is, like any successful agent or like any self-employed person, she had very little taxable income. So she wasn't going to qualify for this. I mean, she didn't want to sell it, but the writing on the wall was that she'd have to sell it. I mean, that was just the deal. In comes the DSCR loan. So the DSCR loan is a debt service coverage ratio loan. It's not like your traditional loan. There's just like the community program. There's no income, no employment, no tax return verification. It's purely using the subject property's cash flow to qualify. It's using how much equity there is. In that case, she was refinancing, or how much down payment that person's coming in with versus what the cash flow would be. In this, as far as the overall breakdown for it on a purchase or rate and term, you can come in with as little as 25% down on these. Very straightforward, especially for any investor who's trying to diversify their portfolio. Maybe they sold a recent property, they want to go buy a couple more. They can take chunks of that and go buy multiple properties using this DSCR loan. Cash out up to 70%, again, not unlike the community program. And as I mentioned, no income, no employment, no tax returns. It's incredibly straightforward. You're qualifying just on the subject property's cash flow. Loan amounts are up to $3 million. So again, a lot of flexibility there. And there's also interest only available. So what I would say is, as Barry and I have mentioned, we want to give you little nuggets so that when someone's talking to you, a client, an investor, that the light bulb goes off when you hear certain things. Things you should be listening for this is someone who's looking to buy investment properties. someone who's looking to diversify their, real estate portfolio. Self-employed, looking to generate rental income. Or also if someone came into a lump sum of cash, right? Maybe someone in the family passed, they have a bunch of cash, they want to diversify that and buy multiple properties. This is a killer program for those types of clients. Barry, if you could jump to the next, we'll get right into the next one. And again, any follow-up questions on there, throw it in the chat. We'll try and address it after the fact, or we can just talk offline. The second piece here is down payment assistance, kind of the opposite end of the spectrum here. So we have a few different down payment assistance options that we're going to go into. Down payment assistance is basically non-existent the last 2-3 years because of how insane the market was. There are properties that had 20, 30 offers on there, all cash, 50% down. Sellers just weren't willing to listen to anybody who had down payment assistance. It's not quite the same situation anymore. It's still, and all of you agents would know more than we do, but it's still more of a listing or rather a seller's market right now. But there is a little bit of flexibility, especially if a property has been sitting on the market, maybe it's priced a bit high, you may be able to get a client, a first-time home buyer, in using down payment assistance. A little story we had a young millennial family with a new addition on the way probably about 4 years ago, and they were outgrowing their current rental, and they made decent money. They just didn't know how to really save it. It was hard for them based on their just living month to month. Their landlord hit them with a rent raise, and they were just fed up. They're like, we need to explore home ownership. So they came to one of our brunch and learns that we did that was tailored for first-time home buyers, and within 3 months they closed escrow using down payment assistance and a closing cost assistance program. And they bought a home for right around $1,000. Think about that. $1,000, that's less than probably a security deposit on their next rental. So there are a lot of different opportunities. There's a lot of different programs. The first one I'm going to talk about is the CalHFA program. It's a My Home Assistance program. It's a deferred payment, simple interest rate loan. So basically, the first mortgage is is your typical traditional mortgage. It could be FHA in this, it could be conventional. This CalHFA would be a second mortgage that they're not actually paying monthly for, which is great. It's for low to moderate income first-time home buyers. When I say first-time home buyers, that means they couldn't have owned in the last 3 years. Provides up to 3.5% of the sales price or the appraised value, whichever is less. They have to meet the income requirements, but Barry, if you could click, you'll see the income requirements are actually pretty lenient, pretty flexible. So for example, Riverside income cap on this is $173,000, and Los Angeles $180,000. Orange County is $235,000, which if you're making $235,000, you can't save some money. I get it. We all live in SoCal. We know the cost of living, but really flexible in considering they're going to be giving you essentially the down payment, and you don't have to pay it back on a monthly basis. So 640 minimum credit on this, 700 or greater is going to give you a better debt to income ratio threshold. If you have 700 score or higher, you can go up to 50% DTI. And as Barry mentioned, you don't need to know all the nuance of this. That shouldn't be on your plate. Whether it's your lender, whether it's us, let us take that share, of what's on your plate and do what you do best. Again, borrower has to be first-time home buyer, and there's also closing cost assistance available. I wouldn't necessarily suggest it with where rates are currently. Basically, there's another program called the ZIP program, zero interest payment or zero interest program, where it gives them additional closing cost help. The problem is it bumps up the relatively competitive interest rate on this CalHFA pretty substantially. So unless they don't have any money at all, I would say stick with the CalHFA loan and not the ZIP program. But again, we'll be able to determine and prescribe whatever the best solution is for any one client. Everyone's different, right? If you could click. All right, now this is another type of CalHFA loan. This one's growing some traction because it really grabs people's attention. It's the CalHFA Forgivable Equity Builder Loan. Essentially, what it does is it's giving the borrower 10% equity right off the bat, 10% down. So really helpful from a monthly standpoint, right? You're not, if CalHFA typically gives you 3.5%, this one's giving you 10%, then your overall monthly payment is going to be much less because it's at 90% loan to value as opposed to 96.5. On FHA, the minimum FICO is 640, conventional is 660. And again, first-time home buyer, must be a primary residence for 5 years. Now, the caveat that's important there, it must be primary residence for 5 years, because the key word in this forgivable is only if they've been in that property for 5 years once they bought it. So if they move out in 3 years, they have to pay a portion of that 10% back. Not the end of the world, especially considering real estate's only, although it's cyclical, it's only going in one direction. They'll probably have equity to pay it out. But yeah, it needs to be in there for 5 years. After that 5-year point, it's forgiven immediately. And then you can go up to 105% combined LTV, loan to value. I would say that, again, this one's grabbing a lot of people's attention because it's 10%. It sounds great. But it's much more conservative in terms of income requirements compared to the last one. If you recall, Orange County was 230,000 was the cap. This, you can't exceed 80% AMI, or the area median income, to qualify for this. So to put it in perspective, I mean, I think I looked at one of the area median incomes, it was 77,000, 80,000 a year was the cap to qualify for this. So it's a very specific type of client. We're talking about maybe someone who, wants to get a 1-bedroom condo somewhere, right? Maybe somewhere in the Inland Empire, you'd be able to potentially use this. They don't make a ton of income. They want to buy a condo, townhome out there. This would work for them. And again, the biggest thing is not having you identify, who needs what or what program. It's just giving you some extra tools in your tool belt so you can go, oh, you know what? Like, I know you said that you didn't want to buy right now, or you didn't think you could buy. Why don't you talk to Barry and Shane, talk to my lender, and they'll be able to diagnose, what potential programs are available to you. If it makes sense, great. If not, then, you can go on your merry way. Go ahead and click there, Dad. And the last piece of the down payment assistance, or in this case, this would be a closing cost assistance program. This one is unbelievable. It's 100% forgivable grant. So the grant provides up to $25,000 to help borrowers pay for loan-related fees and closing costs. So it doesn't help with the down payment. This is going to help with closing costs. It'll work with FHA. It'll work with a conforming loan. So it can be applied to various different things: lender closing costs, third-party fees and settlement costs, and then points to buy down the rate. So you could theoretically, so long as the property qualified, and I'll go into that in a second, you can use this to buy down the interest rate permanently, not 2-1 buy down. You can literally buy down the rate, probably a full percentage based on the purchasing price for any given client, just by using this grant. And the moment that they close on it, that $25,000 is forgiven. They don't have to pay it back. Now, I mentioned the area. This is all specific to a property census tract. So again, you're not going to be able to know that. All you have to do is shoot Barry or myself a text, and we'll look up to see whether it qualifies. Basically, the property needs to be in a census tract that's 50% or more minority. The borrowers don't have to be minority, and none of that. As long as the property qualifies, and as long as they qualify, the investor for this is, you generally want to have a pretty clean overall profile. You want to have decent credit. You want to have somewhat of a decent down payment or some reserves. But again, game changer, $25,000 towards closing costs. You can pay your FHA UFMIP. That's a mouthful right there, the fee that FHA has. And this is, I find a lot of agents that are doing open houses, they're listing agents, they're leveraging this if their property qualifies for it in a very different way. If a buyer does come in and they want, say, credits for a 2-1 buy down, or they want to bid $20,000 under what the asking price is. If the property qualifies for this, you can use this in lieu of that. You could say, listen, we're not going to do a seller credit of $20,000, but there is this grant. If you can qualify for it, this could be potentially helpful, and you can kind of meet us in the middle there. So that is the forgivable grant. That's essentially the DPA, the down payment assistance and grant section of this. So things you want to listen for on down payment assistance. Again, I make decent money, but I don't have much saved. A lot of people will go, I want to buy, but I need to save more money. And Barry and I's question initially is, well, who told you that? Why? Who told you need to save more? Generally they're buddy bought with 20% down, or they're looking online and they see that, that 20% down is kind of the sweet spot. Most of the time people are just self-diagnosing themselves, and they don't actually know what's available to them. So if you have someone who's on the fence, been thinking about buying, doesn't have a ton of money saved, I'd encourage you to connect them with us, and we'll let them know what their options are.
Guys, we want to also give you a gift for showing up here today. If you want to go ahead and take your phone and scan this, this is a really cool tool called Altos that will help you when you're talking to potential sellers, about realistic goals, and whether or not you can actually show them the data as to whether or not they're their heads in the clouds when they're thinking about selling, or whether it's grounded. So I'll give you a second to take a picture of that, and then I'm going to move on. We're almost done here, and then we're going to go over the Q&A with you because we have quite a few questions here. And again, I know that it's frustrating because you guys want to talk to us. We want to talk to you too. But, it's like, I often tell people I'm like a kitten with string. Like Shane is constantly saying, Dad, focus, like, get in. Like, because, I've got text going off. I got emails. I've got people knocking on the door. But so if we had it open where you guys could all just ask us questions, this would have taken 3 hours to do it. Because I would have went off on some tangent about an experience I had in Okinawa or something like that. So hopefully you got a chance to scan that. If you're having troubles, we'll get this over to you later. I want to, Shane and I want to just kind of, first of all, let's go over some Q&A, son. So yep. First question, let me see.
I think we covered, I answered a few live, but we can jump. If there's anything that we left out, guys, go ahead and throw it in there. Let me pull up.
So one of the questions from Kathy is how high of a loan can you do on a 2-1 buy down? And, I haven't found the cap yet, but I think with UWM, it's $3 million. We just did one for like 1.6 million, Kathy. So again, what I would want you to do is, let's talk about each borrower. If you have somebody you want us to talk to, you just be the person that's listening and just go, I want you to talk to my lender. My lender is going to be able to, because if you don't know this, we're lucky right now. There are a lot of our agents in this meeting right now who will tell you that one of the things they're the most happy about with us is the fact that we really go out of our way to educate our clients. I mean, I apologize for my industry all the time because 99% of the loan officers don't do what we do. It's impossible for your clients to make an intelligent decision without knowing, whether or not this is a great time for them to buy, whether or not they can afford the monthly payment, if rates are going down or are they going up? Are they going to need to take care of their parents someday? Are their kids going to be leaving for college? Like, we go into a great detail with our clients to educate them. Even if they don't use us, we still feel like it's our duty as professionals to do whatever we can to take somebody and then have them walk away and go, wow, I really learned a lot from them. One of our top agents, Carol Houston's on here with us right now, and she actually, we had a client, we went out of our way to help them. They got a better deal from the bank that they were dealing with, and we told them you should go to them. We've done our job. We wanted to make sure that person was educated. So the True Story Realty team had a great buyer who felt educated, informed, and they could move on and make the right decision. So we want to, just really kind of imprint on you that we don't expect you to be experts. We just want you to have a high level understanding of this. Yeah. What we also want to do is we want to
just want to touch on a couple of these. We got
yeah, go ahead, son. Go ahead, answer another question.
Dina had asked about in-depth overview for no income verification loans and investor loans. That was at the beginning. So Dina, if you have any follow-up questions, let me know. We'll tackle that. How high of a loan on 2-1 buy down? You got that. We can go pretty high there. The equity builder income limits just per household, or are they different depending on household size? So generally CalHFA will use the income for the borrower and co-borrower. So if you have a son who's working there, who's working a full-time job and they're not on the loan, and that isn't taken into account, that same thing for the grant as well, that it works the same way.
Shane and I have been in the unfortunate position, and I say that jokingly, but where we had to help an agent do a low-income housing thing. And I mean, if your kid has a paper route, they count that income against you being able to qualify for low-income housing. It's
oh,
not
she's talking about yeah, down. Oh, you're talking about versus down.
Yeah, I'm just saying it's not the same thing as with CalHFA.
Very different. Yeah, Carol, that Altos program is from a title company. It's one of our title partners that we've worked with. Super helpful. Very, very helpful for both when you're doing.
You don't have to use them. The tool itself, Shane and I use it when we're doing our open houses, you know.
Yeah,
so
yeah. Another question, could that equity builder loan be combined with the last $25,000 grant? That's a good question, because the investor that does the $25,000 grant, they allotted $3 million of their funds just to do this grant. I mean, it's like, well, it's not.
Let me jump in there, son. So here's the thing you got to understand is that there are limits on, you know, how much of a credit a borrower can have, depending on whether it's a FHA loan, it's 6%. If it's a conventional loan, it's 3%. So at some point, they might have too much credit that can't be used. It would just, you know, we would say on an individual basis, but I get that would be a question I think that we have to hit up the investor on. But I think the limits would be, you know, where are we at with what program are we using exactly?
Yeah, I'll reach out to that investor. I don't think it can be, because I believe that grant only works on conventional or FHA traditional loans, whereas the CalHFA, although it's a FHA or conventional loan, it's still technically a separate section because it's CalHFA. But I'll double check and confirm, Savannah, on that. Good question. Another question.
Go ahead.
No, go ahead. No, go ahead.
No, you go ahead.
Oh, no, you go ahead.
I just wanted to say, you guys may not know this, maybe you do, maybe you don't, but FHA just lowered their mortgage insurance premium from 0.85 down to 0.55. Guys, this is freaking huge. Like, it's going to make, you know, I mean, FHA is kind of associated with first-time home buyers, but you don't have to be a first-time home buyer for FHA. It's associated with first-time home buyers because they have a better interest rate, you know, than a like Diana and our team is working with Diana, who's on here right now. We have a borrower made too much money for CalHFA. So I'm like, well, let's do FHA. FHA, the interest rate, if this client was going for a conventional loan, would have been like over 8%, and they would have had to come in with like $15,000 in points, because conventional loans are really not tailored for somebody who has less than a 760 credit score. If you've got a 700 FICO or you've got a 650 FICO, you do not want to go conventional. With FHA, we looked up the interest rate and it was 6.75%, even though this client only had a 645 credit score. And guess what? The mortgage insurance premium, which a lot of you may not know the difference, but there's PMI for a conventional loan, private mortgage insurance, and then there's MIP, which is for the FHA loan. It stands for mortgage insurance premium. Same thing. One thing is that the federal government insures it. The other one is a private company. They just lowered their monthly mortgage insurance payment by 30 basis points. So let's say if it was $1 million loan times 0.85%, that would be $8,500 a year, or $708 a month for the mortgage insurance premium. Well, with the new mortgage insurance premium going down, that same $1 million home at 0.55% is only $5,500 a year, or $458 a month. So they just lowered that, like at the beginning of this month. So if you guys have, you know, first-time home buyers or people with just, you know, they don't have the best credit, we're going to try and figure out what program is best for them. I mean, Shane and I are problem solvers, and we kind of have a reputation for that. And with that said, I want to say to you, some of you we met at the Forward coaching event in Huntington Beach. And if you remember, Diana DeGrosse, who was heading that up, encouraged all the realtors in there to have lender partners. The realtors that go out there and go, here's 3 cards, call whoever, and whoever you jive with, wind up not making as much money as the realtors that have a true lender partner. And I can tell you that the real lender partners that we've been privileged to work with are realtor partners where they consider us part of their team. I think they would tell you that we've helped them get more business. In fact, one of them, we increased their business over 50% within the next 2 years after they chose us as their lender partner. So we really want to encourage you. It doesn't have to be us. If you don't, if you have somebody else, try to draw in tighter with your lender partner because they're going to help you get more business. And then Shane, also you wanted to mention something, about, earning potential and working with clients that you could.
Yeah, and in a nutshell, to Barry's point, if you don't have a true lending partner, and frankly, this goes for title and escrow, like you should be the Avengers. You should have a team that is helping you, not just with qualifying or getting the job done or answering their phone. You want to be able to lean on these people to maximize your earning potential and you're likely going to close more clients if you have a true partner that's willing to strategize and help you understand their side of it and take that off your plate. That's pretty much all we wanted to get at there. I want to address a couple more of these questions here, but
go ahead.
One of the questions was, can you use down payment assistance to buy down the interest rate? Down payment assistance, you cannot, because that is only for the down payment. That closing cost grant, as I mentioned, that can be used to buy down the interest rate. So
for the permanent interest rate, but not for a 2-1 buy down is considered to be a temporary buy down, but buying down the permanent interest rate is allowed with a program like the grant that we were talking about.
Correct. And I think we just have one more. I'm going to double check here, but we have Dina asked about, we got a couple more. Dina asked, about how about college kids with part-time employment? Can parents co-qualify their adult children for a loan, or is there a program that might work for that scenario? It's super common, Dina, for a client, generally someone my age, someone younger, to have their parents jump on the loan as a non-occupying co-borrower, whether they have employment or whether they're going to school. We just need to identify whether the parents are willing to do that, right? And then what sort of income are they bringing to the table that we can qualify everyone based on that figure? So good question there as well. Yeah, it's non-occupying co-borrower, more common than not with millennials and with younger folk.
Dina, also, we've, I'm not kidding, like dozens of clients that have been non-occupying co-borrowers for their kids who are going to college. Your kid's going to USC and you don't want them living in a dorm, or, maybe they have a few friends that, would help pay for the, pay rent at the place. They'll buy a property with their child on the loan. The child doesn't need to have, to Shane's point, doesn't need to have income, but they do need to have some credit. So if you're going to put them on the loan, they want to have a little bit of credit, maybe a credit card or two. The parent goes on there as a non-occupying co-borrower, not a problem. Yep.
A couple more, really just, I think, do you do reverse mortgages? Absolutely. Barry is, if there's anything Barry's passionate about, it's me, his family, TV, any TV show you can go to him about, veterans and reverse mortgages. So we absolutely do them. Barry could give, a 4-hour lecture on that. Marcos, thanks for joining us. I know you're taking off. I know we're getting to the end of this here, but I'm going to get to him with the Cal Halfa flyers. And then the last question we have is, how quickly can you close? It's all dependent on, the client's situation, right? We can close in as little as 10 days. If we have all the work done up front, the sooner you get us a client, the sooner we get us a feel for their situation, get the documents in line. To Barry's point earlier, we closed a VA loan in 14 days, which is, we had streamers and we had champagne. Barry doesn't drink, but I was drinking it. We can close very quickly. But if it's a non-QM product, if it's a Cal Halfa, if it's a 203K renovation loan, those sorts of things take a little bit longer. So back to the original point of being in close communication and having a good relationship. Talk to us as we're, as you're structuring an offer on a property, and we'll be able to tell you realistically, hey, we can do it this quick. It's going to take a little bit longer. But yeah, another good question. So guys, again, parting words for me is just thanks so much for being on this. We hope you got something out of it, some nuggets. And we want to be able to continually do that. So if there's anything we didn't cover, anything that maybe you're hearing about in the market that you want us to do a webinar about, we'd be more than happy to put some together like we did today.
Call and email us. I mean, it's amazing how many agents that we talk to that are really good at what they do. Maybe they just got started, but they don't have a good grasp of loans. We don't want you to be an expert on it, but we want you to at least know some basics. So we're thinking about doing like a home financing 101 course where, maybe we do a webinar, all about how to fix somebody's income. I'm sorry, not their income, but their credit score, how to improve their credit score. We talk about, some of the no-nos, like if you don't have commissions for at least 2 years, things like, if you guys are interested in some basic loan type of webinars, let us know, but make sure you email us or call us if there's anything else that you'd like to see us cover. Cannot thank you enough for all of you being here. It means so much to us. And we'll have a recording of this that we can share. If you know anybody else that could have used this, please let us know and we'll be happy to send them the recording. Thanks, guys.
You guys have a great rest of your week.